Mahesh Patil, co-head equities with the Birla mutual funds. He joins us live now. Mahesh, good morning. Thank you for joining us. Mahesh, what do you make of last week's price action? In quick time, Nifty has added about 5%. Do you think worst of the price adjustment is behind us?
Well, as you rightly said, we have seen a sharp run-up in the last few trading sessions. I think the concerns were about QE tapering, and we've seen withdrawal of flows from our markets, not only our market but also other emerging markets, and that led to a liquidity squeeze, and we saw a sell-off over there. But I think more recently, I think the data point which came in from the US a few days back, wasn't that great in terms of economic recovery, and we saw the markets again bouncing back from the oversold levels. I think the key challenge remains in terms of how soon you will see the QE tapering, and more data points coming in the US is what I think markets will watch to get some clue in terms of when the withdrawal of QE3 will start. And I think yesterday's data which came in, PMI data, showed that it was good again, so that's not so good in terms of money moving out of the emerging markets. So I think in the near term, one would see a lot of volatility, and one has to really watch in terms of how this global situation normalizes. Purely from a domestic fundamental standpoint, I think we're still seeing the recovery process, what we were expecting. I think that's going to be pretty slow and tepid. We have scaled down our GDP growth forecast for this year to around 5.5%. And our belief has been that market would probably be range bound for some time. We don't see any big upside, neither we see a big downside for the market. So it will be in a trading band.
Mahesh, hi, morning. So what's been, the nature of the outflows that we've seen? Is it only ETF money, or do you think some long-only money as well is pulling out now?
Well, I think initially it was, I would say, asset allocators globally, when they pull out money, so money moved out from emerging markets. We've seen across not only India but also the other emerging markets. In fact, the money which has been pulled out from India is much lesser than what we've seen in other markets like, say, Indonesia, Thailand or Philippines for that matter. So it's initially the asset allocators, moving out money, and then if we see further redemptions in some of the global funds, then probably, or India dedicated funds, and then I think you will see money moving out of some of the long only funds also. But I think we haven't seen that phenomena as yet. It's purely asset allocation, money moving out of some of the ETFs and some of the emerging markets back into developed markets.
Mahesh, the Fed communication has clearly led to a synchronized selling in all asset classes. Bonds got shredded, equities got whacked, gold and precious metal stocks also took it on the chin. Now that the dust has settled down and the global financial Armageddon is behind us, do you think a market like India will clearly tend to outperform?
Well, I think India's outperformance will be driven by two factors. Whether we see the trade currently which is being played out, money moving out from emerging markets to DMs, developed markets, where that continues for some time. If that happens, clearly I think India might underperform. And secondly, it depends, could be purely from a standpoint in terms of what India gets as a share of the total money which is allocated to emerging markets. I think year till date we have been fortunate enough to get a larger share of that pie, because we have seen the other markets, especially Brazil and China, not doing that great. I mean, each of these economies have their own sets of problems. China is actually moving into a phase where they're seeing a further slowdown and tightening by the central bank. And even in Brazil, we have seen actually central bank increasing rates and inflation again raising its head over there. So I think in that context, probably India is better placed among the emerging markets. So if we continue to do and behave properly, and the fact that current account, which has been a bigger challenge for us, if that also contains, which we believe should happen going forward in the next few quarters, it should come down to around 3.5% or so. I think we would have a fair chance of getting a higher share of the allocations. And if our recovery and if we see panning out slowly and steadily, then I think there is no reason why we should not do relatively better. But it all depends on relative how India does vis-a-vis the other emerging markets and vis-a-vis the other developed markets.
The big theme in last 2 years has been that we've seen a massive and a big P expansion in consumer and pharma stocks. Do you think the P expansion in some of the consumer and pharma stocks will continue, or this is as good as it gets for that sector?
Yeah, you're very right. Actually, we have seen in the last 2 or 3 years, essentially money which has come in has moved towards some of the stable and companies where there is visibility and stability of earnings. So we have seen the consumer sector, also called defensives, valuation multiples expanding. And in fact, we did some analysis and we've seen that the differential, the divergence between the defensive and some of the other cyclical stocks is at an all-time high. And even some of these consumer names are trading at P multiples or valuation multiples which are probably 1.5 sigma or 2 sigma compared to the long-term average. So clearly these valuation multiples difficult to really sustain at these levels whenever they reach those levels. But I think market being as it is, I think this trend can continue for some more time. One doesn't really know, but clearly I think we would not really want to pay those kind of multiples at this point in time, especially at a time when we are seeing some kind of a slowdown in some of the consumer names also in terms of volume growth. More recently we saw in the last quarter, and looking at the current trends, especially in the urban side, we've seen consumption slowing down. So I think that should weigh down in terms of earnings growth trajectory also for these companies. So given the valuations, high valuations, and some kind of a slowdown, there are very few names where we find the growth and the valuation really trade-off favorable for us to really invest into in this sector.
Mahesh, what's your sense on the currency right now? And does it seem like the rupee is now testing the RBI's patience come next policy, and the RBI perhaps may be forced to raise rates purely because of the kind of weakness the rupee has gone through?
Well, I think on the rupee, we have seen the rupee coming under pressure. I mean, obviously we have a high current account deficit, but also primarily because of dollar strengthening and the kind of capital flows, outflows which we saw on the debt and equity, because a current account to a large extent is funded through short-term flows, not through long-term money. So I think we've seen that trade being played out, and at 60 levels, I think fundamentally, I think it should find support over here. But in the near term, how the rupee movement will be clearly driven by capital flows, because that would keep the rupee volatile. But I think looking at the fact that current account deficit is also high and the global factors, I think the RBI might stay away in terms of trying to reduce interest rates in the policy what we are expecting in this month.
Mahesh, historically we've seen that there is a very strong connection and correlation between monsoon and rural spending. This year monsoons have been good, they've been above average. Are you aligning your portfolios? Are you buying into companies or stocks which will benefit because of a good monsoon? If yes, which ones?
Yeah, you're right actually. This time the monsoons have been pretty good, pretty early, and much ahead in terms of expectations. So I think the rural side consumption plays should do reasonably well in this context, and one has to really look into that. But as I said, yeah, there are certain unique plays, whether it's in the rural side or in the agrochemical side, okay, which could do well. We see typically these stocks are seasonal in nature, and with a favorable monsoon, one could expect better performance from some of these companies.
Should run by two-wheelers, rural FMCG companies, agri stocks, tractor companies?
Well, again, I would say one has to look at in terms of, it's still slightly too early to look at it. I mean, purely the sentiment-wise, I think that should be favorable for some of these stocks. I mean, on the two-wheeler side, it's not only rural side, but also it's the overall outlook. We have seen weak numbers coming in from the two-wheeler space or the broad auto space because of general slowdown what we have seen in the economy. But I think this is again a transition phase, okay, what we feel for the auto sector. We feel that because going forward we expect interest rates to come down while it's got delayed a bit. And in terms of a recovery, I think second half of this calendar year, we should see some recovery in the auto space. And again, these are sectors where the valuation multiples are pretty reasonable. The companies, they generate good free cash flows. So I think auto could be one sector which we could look at slightly from a medium-term perspective if you want to play the rate cycle also and the rural consumption story panning out.
Mahesh, I know it's difficult to predict a number, but we are now less than 5% away from a new all-time high. Even though we are, 5% away from a new all-time high, the market sentiment is reminding me of a bear market low. Do you think somewhere it's the overall pessimism which will fuel markets up?
Yeah, I think, see, what has happened in the last 5 years, if you look at it, I mean, markets have gone nowhere. And we have seen a spate of negative news hitting the market. It's been, whether it's global initially, and then slowly in the last 2 years, it's been more domestic. And even during that period, we have seen the corporate earnings really growing. GDP, while it has slowed down, it's still grown. So I think clearly, while negative around seems, everything around seems negative to a large extent, I think a lot of it got priced in really. And even in terms of flow, domestic investments, if you look at it, we haven't seen much inflow. So people have also underinvested in the market during that period because money has moved into other asset classes. So I think that should, despite all the negative, our belief has been that markets should find good support. And slowly and steadily as we see a recovery, because mind you, we are at the bottom of the cycle. That's what it looks like as of now at least. And we are in a period where we are seeing now inflation easing off. Interest rates, yeah, definitely will come down, while the pace might be slower than what we were expecting earlier. So clearly from all these points, if you look at it, then clearly it's a phase where the market is trying to consolidate or trying to form a bottom. And with some kind of recovery, if we see uptake in the economy, I think that should be the next leg for the market to really push off from the, as I said, the all-time high and take to a new level. But yeah, I mean, the time period is very difficult to predict whether that will happen in the next 6 months, 1 year, or probably this thing. But clearly the trajectory should be up. That's what we believe from a medium-term perspective.
Mahesh, what about IT? Has the trade played out there? Is it time to now book profits?
In the IT sector, we have seen actually the sector has done reasonably well despite the concerns about the US immigration bill. I think that bill is now passed in the Senate now, and there are certain indications over there. Let's see, because it has to further pass into the next level. There could be further dilution in terms of the norms which are impacting the IT companies. So there could be some impact, I think, if it goes in the current form to the earnings for the IT companies. But I think we have seen some amount of recovery back in the US economy. And even the IT spends are marginally better than what we have seen last year. So given that, I think the sector should do reasonably well, and especially in the current environment, okay, where we have seen pressure on rupee and domestic concerns. I think I believe the sector should do reasonably well. Our view on the sector has been neutral. There are certain companies which are doing much better than some of the others. So I think we focus on companies which are able to grow at least in line with the industry average or above the industry average, where our focus will be within that sector. But I think sector should do reasonably well.
Final question, what's happening to flows? Have outflows become inflows?
Flows, we have seen actually strange. I think we haven't in the more recent past, especially in the last 1 week or so, whenever the markets have corrected, we have seen some money moving into our funds. So I think investors are realizing that in a market correction, when the markets become slightly more attractive, we have seen flows in our fund, but nothing really big. It's been steady trickle. At least the outflows definitely have stopped. And as we see actually equities, I mean, if you look at other asset classes also, whether it is gold, a lot of money in the last 5 years has moved into gold and real estate. So gold as an asset class now has actually turned a bit sour, I would say, because looking at the recent experience, and the outlook also is not that great. And as interest rates go down, I think even the high income which people generate in the fixed deposit, so that would also start to come down. So I think increasingly, I think one should expect money moving into equities. And we have seen the early trends of that, especially in a market correction. So that's pretty heartening for us.
Okay, Mahesh, good chatting with you, and really appreciate you taking the time out and joining us.